Today, Scott is speaking with Associate Professor Ed Graves about another research report he conducted looking into the future of individual life insurance. Let's join them now in the studio.
Thanks, Kevin. Welcome, Scott.
Thank you.
Can you briefly describe the state of domestic insurers today? How does this contrast with the situation?
Annualized premium sales, new sales, from 1980 to 2010, sales have gone from $4.9 billion to $12 billion. The bad news is that when adjusted for inflation, if we look at this in 1980 dollars, sales are actually down from 4.9 to 4.1. On top of that, the number of policies written has continued to erode, and our research shows that life insurance ownership is at a 50-year low. So the reality is that life insurance on its own does not have as their primary trusted source of information. People still want to work with advisors, and that's true as well for generations X and Y. And once the advisor has that client purchase a policy face-to-face, we need to make sure that the relationship is strong and that the service provided is excellent. Because if a person buys face-to-face the first time, they are much more likely to buy face-to-face their next time. And we need to make sure the advisor is there to serve that need.
That's an important point, isn't it?
Retirement income planning or long-term care insurance.
Thanks for joining us, Scott. Back to you, Kevin.
Thanks, Ed.
Funding for 2011. Beginning this year, taxpayers are allowed a higher phase-out threshold for deducting education savings bond interest than in the past. Married taxpayers filing jointly can now earn up to $105,100 or $70,100 for single taxpayers and deduct interest on education savings bond if the proceeds are used for qualified education expenses.